Good evening, everyone. It is an absolute joy to welcome you all to this special session on Integrated Business Solutions paper brought to you by Board of Studies Academic. We truly appreciate you taking the time to be here today. Unlike conventional subjects that focus on rules, standards, regulations, calculations, the IBS paper invites you to step into the shoes of decision making. It challenges you to think beyond the silos of theory and dive into real dynamics of business, finance, strategy, compliance, as well as taxation. Let us take a simple example. Okay, imagine a listed company wants to diversify into premium chocolate manufacturing. Okay, at first glance, this appears a strategic move. However, such a decision is not isolated. It is so much linked with financial, finance, tax, and regulatory framework. Since the company is listed, the SEBI LODR regulations, any significant investment or diversification must be disclosed to stakeholders through proper stock exchange filings, transparency, and good corporate governance practices. If a company is listed, therefore, SEBI LODR regulations are very relevant. Therefore, in this case, you may surely get question from this portion. Therefore, don't ignore this portion. Okay. From a direct tax perspective, if if company decides to set up a food processing unit, there may be situation company is eligible for claiming deduction under section 35 AD. From indirect tax view, accurate classification of chocolate products, whether they fall into luxury food items or standard processed food, is essential to determine the applicable GST rate. Additionally, the company must ensure input tax credit flow on machinery, packaging, and marketing costs to avoid future disputes. From finance perspective, there may be evaluation of various financial proposals. Company may decide for ECB, external commercial borrowings. If wants to import some specialized equipment, in such case, FEMA will also be applicable. Okay. So again, it is very important to think holistically. Okay. Every decision is woven with multiple layers of strategic planning, financial structuring, tax optimization, and regulatory compliances. In our previous sessions, we explored a number of case studies like in fast fashion sector, we examine how lean supply chain and short product cycles drive competitiveness. The aviation industry showed us how airlines balance operational costs. For FMCG companies, we discussed the role of branding, customer insight, and fast moving logistic framework. In tea sector gave us insight on agri-based supply chain And in transportation, we saw how app-based logistics are transforming delivery models and public mobility solutions. Through these examples, we have reinforced a critical insight: strategic decision cannot be viewed in isolation. Today, we bring you interesting case studies from Case Study Digest. All the case studies and relevant material are already hosted on BOS Knowledge Portal. I encourage you to review them carefully. Today's session will be interactive, so please feel free to ask if you have any query, whether in Hindi or whether in English. You can either speak up or type your queries in chat box. Additionally, in the last 15 minutes will be for general discussion. We are fortunate to have with us CA Bala Subramanian sir, a well-known chartered accountant you already know. He is an active management consultant who works on project feasibility studies, business plans, business structuring. He has also handled various merger and acquisitions and internal audit assignments. As a certified fraud examiner, he has played an important role in several fraud investigations. In addition, he brings strong expertise in consulting the banking, financial services, and insurance sector. His expertise will help you to connect theoretical knowledge with practical business applications. With that, let us begin with today's session and explore insightful business case studies. CA Bala sir, over to you.
Thank you. Good evening, all. Before we start, let me first share the deck so that we can then discuss. I hope the screen is visible. Yeah, good. So let's go into today's session. Uh, like he was mentioning, the case studies we are going to look at today are all already in the case study digest, which the institute has come up with. These are some case studies picked from that, very interesting ones and very important from a learning perspective there. So, without much ado, let me take you in to the first case study for the evening. So, this is the case study about RP Limited, which was into fabric, not fabric, actually, garments. Garments export was a major business line for them, and how certain developments in that company and in its related operations became very important, and there were some critical issues which are arising from that, and how these were addressed. So, this is what we are going to be looking at today. So, essentially, just to give you a background about this RP Limited. RP Limited was based out of Tirupur, as you all know. It's a small town near Coimbatore in Tamil Nadu, which is known for its knitwear, right? The bunions, the t-shirts, and all that. Anything which is a knitwear, Tirupur is a famous name, global exporter from India. That is what it's famous for. The whole city is famous for that. And this RP Limited was also established there in 2003, quite some time back. And it was a prominent manufacturer and exporter of t-shirts. So this was the establishment which was already there. They had significant exports. They were well known in the export market. Their brand RK was known for its quality, the ethical practices, the style, whatever they were bringing to table there. So RPL also had state-of-the-art manufacturing facility, which was equipped with advanced technology and machinery, and their production processes adhered to stringent quality control measures. So there were very tight quality control measures. So when you find a RK product t-shirt coming out, it largely met the expectations and it surpassed expectations in terms of quality, etc. Right? So this was the reason why they were doing successfully well in the market all over the period. So their customers were all significantly loyal to the company, right? Very loyal to the company. Their customer base was continuously, once again, continuously supporting them from their side also, right? Because of the quality products which they were getting. Not only quality product, timely delivery, the right, the products in terms of style, color, etc. for the markets. So they had the right approach to the whole thing. The product portfolio of RPL was also significant. So it was meeting the requirements of multiple geographies, demographies, and the fashion trends which are globally happening. So there is a lot of close coordination which happens in this industry between the buyers who are ultimately going to sell it in the markets and the manufacturers who are based in countries like India, where the actual manufacture happens. There's a significant amount of interaction which happens to ensure that the whole production is continuously being done in line with the international requirements. I think somebody has put up their hand. Okay, let's see. So it was not only with regard to the styles and the various fashion trends which are important and which were being looked at. This company was also very keen and it was looking at ensuring sustainable growth, and it was also looking to globally expand its footprint. So they were actively always looking for new markets. They were looking at various partnerships which could enhance their reach. So this is something which was going on one side. On the other side, they were also working on how to become more eco-friendly in their practices and business operations in India, in the producing side, essentially, right? So it involved moving towards a sustainable growth model with responsible sourcing happening up to completion of the product and delivery. They were at the same time also focused on improving the manufacturing quality, the facility, innovations, all what is happening in the latest in the market to ensure they are always ahead of the curve and ensuring that their place is not lost to competition. With all this, the company was also largely focused on being ethical in their practices. Right? This was the background to the company which we are looking at. So, in this scenario, what came up was in April 2023, nearly 20 years after the company was formed and it has been growing. In April 2023, the company got into a contract with another company called JM Limited. Let's call it JML for ease. So with JML, to sell t-shirts to them at a pricing of 600 per t-shirt. So they will keep on selling at 600 per t-shirt. That was the contract they entered into in April 2023. Now the contract also mentioned that if JML ends up buying more than 2,000 t-shirts in that year, financial year, which is from April to March, right? In 2023-24, in that 1 year, if they buy more than 2,000 pieces of t-shirts, then there will be a 10% discount on the whole pricing which has been given to them. So 600 rupees will become 540 for the whole year. Even for the items which have been already sold to them before it crossed 2000, it will become 540. So this was the agreement they had got into. When they looked at in September 23, that is 6 months into the process, till then they had sold only 190 t-shirts as against 2000 t-shirts. Very, very small, right? So at this point of time, in September 23, RPL, the company made an estimate that by year end, the sales to JML will not exceed 2000. So there will be no need for giving that 10% discount. So this is what was the background, right? But then what happened in October 2023, the customer, JML, the customer, he acquired another company called DCL. That DCL was a regular procurer of t-shirts from this company RPL. So with that, now they expected that from October, the sales will suddenly jump, because now from October, it will be sales to JML, right? Because what was sold to JML and what was sold to DCL in the past will all be now sales to JML. And as it was expected, just between October and December, in 3 months itself, they sold 1,200 t-shirts. Now, obviously, when December came and when the company was looking at it, they concluded, now we will cross that 2000 threshold. And maybe we'll have to give that discount from April 2023 itself, right? So this is what they were coming to a decision on at that point of time. So it was a significant jump in the sales, all because of some strategic alliance which happened there, right? Now, there was also another dimension. RPL was also analyzing whether, as a strategic step, should they acquire JML through a merger. So this will create a strong brand which can produce, which can also sell, right? So currently, the RPL was more focused on production and selling it to large companies like JML, which then was doing the retailing. Now, this would put them into a different dimension by giving them a forward integration into distribution part also, right? So this was something which was being considered, and this was looking at the synergy benefits which can come from this. Like I told you, you have the marketing strength, and there is also you have the manufacturing strength. There is also the marketing strength which is available with JML. Together, it can give you a significant market positioning. In addition, what they were looking at possibilities of sharing resources and expertise. They could optimize production. They could lead overall to reduce costs and increased profitability and margins for everybody. Right? So this is something which was being considered. And at this point of time, what was the information which was available about the company which was being looked at? The company had, RPL had a 10 crore after tax earnings, which is a PAT of 10 crores, and it had 10 lakh equity shares, and its market price was 75. While this was so, in the case of JML, they had a 3 crores PAT, profit after tax, and they had 2.5 lakh equity shares, and their market price was going at 60 rupees per share. This was the position. So they were considering the merger, and there were discussions going on this account. So while this was going, all this was happening, the company was also undergoing audit. During the audit, the auditor, Ms. Best, who was verifying export revenues, she found the following information. Now, the export sales are being made on payment of IGST. So that IGST, there has to be a refund which has to be applied and obtained. Right? So the IGST refund should come to the company because they are paying IGST and then exporting. Then they also found during the audit that the export sales was being recognized on the basis of when the bills of lading has been prepared. Now, she was not sure whether the preparation of bills of lading is the point of recognition of income. She was not sure, right? And she found that 4 export invoices, the invoices were dated March, and the value was 1.25 crores. These had not been taken into revenue by the company because they said the bills of lading were taken only in April 2024, right? So this is one thing which came up. Now, some of these things may not be covered in the questions, but we can discuss these also when we discuss the questions and other things, right? So this is something which came up. She also found that there was a error in the previous year export revenue recognition also, and that was not rectified, and it was not identified last year. So there had been an unmodified audit report only in the previous year. So these are things which came up during the audit. Then the third point which came up during the audit was that they were also exporting to Japan, right? And RPL had exported up to about 10 lakhs worth of Japanese yen, which were uncollected as of year end. So there was a foreign currency receivable of 10 lakh Japanese yen. Now, for the sake of this case study, let's assume that the Japanese yen was not directly quoted for the Indian rupee. So there was no direct market available for Indian rupee to Japanese yen, is an assumption we'll take. And the spot rates between INR and USD, so obviously USD will become the intermediary currency for determining the exchange rate. INR to USD was at 62.22 and Japanese yen to US dollar was at 102.34. So these were the two exchange rates which were there. There were also forward rates for March which were available at INR of 66.5 INR USD as against the spot of 62.22. The forward rate was 66.5. Similarly, between Japanese yen and US dollar, as against the spot rate of 102.34, the forward rate was 110.35. So the auditor felt that it is better to take a forward cover in this scenario. So this was also one of the recommendations she made to the company, or findings she shared with the company as part of the audit findings or during the audit findings. The next thing which she pointed out was that at the year end, RPL had an outstanding interest liability of 1 crore towards loan payable to a public financial institution. On the last day of the year, the company issued debentures to the public financial institution in lieu of that interest and considered that interest has been settled by way of debentures, and because interest has been settled, they took a view that interest is to be considered as paid, and for the purpose of income tax they claimed it as a deduction. Now you may be aware that there are clauses in the income tax which says that interest to public financial institution can be claimed only in the year of payment and not in the year of accrual, right? Should have been paid to claim that. So here, the view which was being taken was that because they have issued debentures, it is akin to a payment and a fresh instrument being invested into, and accordingly, this can be claimed as a deduction. In the income tax return, this had been disallowed by the assessing officer. So this was also an issue which came up, right? So these are various things which were being highlighted. Now, the other thing which came about was that after the issue of the debentures, the company had a total 3 crores debt, right? So this was the position. Now, in this context, we are going to be looking at some of the questions. We will relook at some of the underlying data again to ensure that we are in alignment, and we are looking at with the case law which we are in, the case query which we are looking at. So the first question is on, with respect to information given in the merger, right? If the merger goes through, right, by exchange of equity shares between RPL and JML, the exchange ratio is set according to current market prices. What is the post-merger earnings per share of RPL? So what I'm going to do is, I'm going to share that table, and then I'm going to ask you to look at it. Actually, because it was Yeah, I think I will share screen. That will make it easier. Yes, now this will be. So what was the query? The query was, if the merger goes through by way of exchange of equity shares and the exchange ratio set according to the current market prices, what is the post-merger earnings per share of RPL? This is the question. So RPL shares are valued at 75. The after-tax earnings is 10 crores and the number of equity shares is 10 lakhs. JML shares are valued at 60. They had a 3 crore pack and they had 2.5 lakh shares. Right? Any thoughts on what will be the EPS post the merger? Anyone wants to come up with any thoughts? So the options which are available are 104, 108.33, 83.33, and 130. So what would you look at it as? Anyone having any thoughts? Anyone wanting to share some workings or thoughts on this? It's a simple, quick arithmetic which needs to be done. Of course, there is a computation to be done if you have to arrive at it. Any thoughts? Okay, so let's look at the answer and then I will explain how it comes about, right? So the answer is B. I'm going to go back to the table and show you how it is coming about. So the first thing is, what is given is that the exchange is happening based on the market price. So market price of RPL is 75 rupees and market price of JML is 60 rupees. So for every share of JML, you will get only 0.8 shares of RPL. How does that come? It is 60 divided by 75. Correct? Are we all on the same track till now? So for every share which a shareholder in JML holds, because its value is only 60, whereas the value of RPL share is 75, he will get only 0.8 shares in RPL, which is 60 by 75. So if all the shareholders in JML are going to get 0.8 shares, 250,000 shares will get 250,000 into 0.8, 2 lakh shares. So RPL for the merger will have to issue 2 lakh shares to the shareholders of JML. That is what is coming up, right? RPL already has 10 lakh shares and they have to now issue 2 lakh more shares. So that makes it 12 lakh shares. Perfect till then. Now, on a merged basis, what is the profitability? The profitability on a merged basis is that uh, 10 crores plus 3 crores, 13 crores is the profitability. Now, 13 crores divided by What is the new number of shares? 12 lakh shares. 10 lakhs of existing shares and 2,50,000 into 0.8, which is 2 lakhs. 2 lakh shares issued to the shareholders of JML. So totally aggregating to 12 lakh shares. So 13 crores divided by 12 lakh shares will give you 108.33. That's how you are arriving at 108.33 as the revised EPS. Now, why is this important? One of the things which people look at is whether the acquisition is EPS accretive or not. Whether the acquisition is EPS accretive or not. So you keep on making acquisitions and then the EPS is going to be going down. It may have some sentimental or it may have some technical implications on the stock market prices as it goes forward. So one of the things they look at is EPS accretive or not, especially for listed companies. They are focused on having a EPS growth happening. So if I'm going to go and acquire companies and my EPS is actually going to shrink, then that may not look very nice from a investor expectation perspective. That may be correct, right? But that may not be the investor's perspective. So from a strategic financing perspective, one of the key things which they look at in all mergers or acquisition is what is the EPS accretiveness or EPS reduction which happens, right? Fair enough. So let's go back to continue on this. Let's look at the question number 2, right? This is about consolidation. Now, certain adjustments would be required to be made to account for the change in shareholding of JML in case of consolidation. These adjustments are known as, right? Oh my, I think there is a memorandum adjustments. There is an error that A, etc. should not be coming there. Memorandum adjustments, current period consolidation adjustment, permanent consolidation adjustments, temporary period consolidation adjustments. So what is it to be called as? Any thoughts on that? So if there are going to be adjustments made on consolidation, right? These are going to be called as memorandum adjustments or current period consolidation adjustments, or they are going to be called as permanent consolidation adjustments, or in the alternative, temporary period consolidation adjustments. So what is it to be? Any thoughts? I think somebody has some thought there. Answer C, permanent consolidation adjustment. Somebody is saying answer C. Anyone else with any thoughts? Option C, somebody else is also saying that. Okay, good. So let's look at the answer now and why. That also we will see. Yes, it is C, permanent consolidation adjustments, because this is permanent and one time on the merger date. These are implications of the change in shareholding which is happening on giving effect to the merger. So essentially, it is a permanent adjustment. So permanent consolidation adjustments are those adjustments that are made only on the first occasion or subsequent occasions in which there is a change in shareholding of a particular entity, right, which is to be consolidated. So it happens only at times of acquisition kind of accounting or when there is an incremental shareholding change which is happening, right? Is that clear? So with that, we can move on to the third question. Based on the information given, we saw that Ms. Devanshi Bist, right? She was doing the audit. So on the audit opinion, considering the fact that the last year's misstatement pertaining to export revenues has been identified in current year, and there was an unmodified opinion issued in the previous year. So what should she do now is the question. Right? The first option is the auditor should give unmodified opinion, but include other matters paragraph in the audit report as last year's profit is being reflected in reserves and surplus because it has happened in the previous year, and because it has happened and it has been missed out in the previous year, it has gone with reserves and surplus. Current year is okay, so current year we should show it as unmodified opinion. The second is the auditor should get legal opinion as to what is to be done. The third is the auditor should express a qualified opinion or adverse opinion in the auditor's report of current financial year, right? Because there is going to be a modification with respect to corresponding figures. This is third option. The fourth option is auditor should give an unmodified opinion, but last year's period unmodified opinion should be highlighted in the emphasis of matter. So, A, other matter paragraph, legal opinion, qualified, or emphasis of matter paragraph. So, which do you think is most appropriate in the scenario like this, where the error is not in the current year, error is relating to the previous year, and it was by chance found out during the current year audit, right? So, what are your views? Any thoughts there? I already see some people have put C. I am not sure whether they put it for this or the earlier one. So, let's look at what is the answer. Let us see if it is C. Right, it is C. We can see, right? Okay, so why is it C? First and foremost, we'll also look at the other things, right? Why it is not, other aspects. First and foremost, there is an error, right? There is a misstatement in the financial statements. So it must be qualified, right? Because previous year figures are also getting reported in the current year financial statement. And so it is getting carried. Your reserves and surplus number, which is there in the current year, also is getting carried at the wrong amount. Even assuming you have corrected it in the current year, previous year figures are still wrong. You need to highlight. So this is coming in para 12 of SA 710, right? I think many of you have pointed out C as the answer, which is good. So the idea is, if the auditor obtains audit evidence that a material misstatement exists in the prior period financial statements on which an unmodified opinion has been previously issued, blah, 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 again, it says that you should consider and give an adverse opinion. Right? So, it is mandatory to give an unmodified opinion. Let's also look at what the other options are. Now, the other option is to include it in other matters paragraph. As we all know, other matters paragraph is not at all meant for anything to do with audit or misstatements found, right? Other matters are purely other matters not connected with the financial statement numbers, which is very critical. Like, for example, other matters could be that last year was audited by somebody else. Other matter could be that a few of the non-material subsidiaries had not been audited by anybody. These kind of things can come under other matter. But it cannot be to about a misstatement. Legal opinion. Now, why legal opinion? Standards of auditing is set by the CA Institute. We are chartered accountants. Generally, we should avoid going for a legal opinion on a standards of auditing matter. Standards of auditing is supposed to be our thing. We should interpret the right way. We should take a view based on the standards which are there, because it is more a technical matter. So that is the second thing. Now look at D. D is talking about emphasis of matter paragraph. Emphasis of matter paragraph can be used only where you are not qualifying, you are only highlighting some facts. Now there is a misstatement. There is a misstatement is something you cannot pardon by highlighting it. So a emphasis of matter paragraph is most used for something which is material or critical in the financial statements, which you are pointing out to the shareholders or any users of the general purpose financial statements, but not in a manner to qualify or to say that my opinion is subject to that, or my opinion is impaired because of that, or my opinion could be impaired because of that. No, we are only highlighting that. In fact, we say after the emphasis of matter paragraph, our opinion is not modified in respect of this matter. So that is the way we have to do it. So hope that was clear, and good. I got a lot of you giving the right answers there and willing to share it. Then going to MCQ 4, which is on the disallowance. Now, what was the disallowance? The company had interest payable on loan to a public financial institution, right? And then that interest was settled by issuing some debentures on the last day of the financial year. The company took a view, by issuing a debenture, we have settled the low interest, and so the interest should be allowed as a deduction. The assessing officer rejected it, right? And his view was probably the interest so converted into debentures and not actually paid shall not be deemed as actual payment, and hence would not be allowed as deduction while computing the profits, right? So the assessing officer may be right. That is one option. Then the second option is the interest converted into debentures shall be deemed as actual payment, but would not be allowed as deduction while computing the profits and gains of the business, and hence disallowance was right on behalf of the assessing officer. The third option which is available is interest so converted into debentures shall be deemed as actual payment and hence would be allowed as deduction while computing income. Even though the liability to pay is deferred to a future date. By issuing a debenture, what is happening? You are deferring the payment to a future date in a way, theoretically, right? Thus, the action of assessing officer is partially correct, as the interest, though not allowed while computing, would be allowed as deduction while computing income from other sources, right? So this was the third view, that it is income from other sources and it should be permitted. It's not profits or business. Then the fourth is the interest so converted into debentures shall be deemed as actual payment, as in the given case loan is provided by a PFI, public financial institution, and hence would be allowed as a deduction while computing the profit and loss for the year, right? Profit and gains from the business for the year. So the action of assessing officer is not correct. So this is the four options which are available, right? And let's see what are the options. Somebody has said A, right? Just to go back, I'm going to explain what is A. A is the interest so converted into debenture and not actually paid shall not be deemed to be actual payment and hence would not be allowed as a deduction in computing the profits or gains from business. So the assessing officer was right in disallowing it, right? So these are the options, and somebody has said A is the right answer. Any other thoughts? Any other options anybody would like to choose? Okay, so somebody else has also put A and has also given an additional thing. Allowed if interest paid before filing return of income. Right? So added input also given. So till now, everybody thinks it's A. So let's look at why it should not be D, right? Because we all want everything to be allowed, right? That's probably one way of looking at it. But the answer is right. A is right, right? So clearly, the provision is in 43B. Interest payable is allowed only in the year in which interest is actually paid. And like somebody pointed out, very valid point, that there was a proviso which was also there in 43B, which says that, okay, if you pay within the due date of the filing of return, you can still claim. Largely, why was this put? Many a times what will happen is the interest accrual, we do accrual basis accounting, and the actual date of payment may fall in the next financial year, soon in the next financial year, right? So in such scenarios, you don't unnecessarily complicate everybody's life by disallowing in one year and allowing in the next year and all that. So they have given a permission that if so long as it is happening before the filing of return, okay, you can adjust it. But the proviso is so worded that even a delayed payment, etc., which was actually due in the previous year itself, is paid before the return is filed, you can still go ahead and claim, right? And then explanation 3C to section 43B clarifies that if any sum payable by the assessee is converted into a loan or borrowing, right, etc., etc., the conversion will not be considered as actually paid. So there is also a clarification which is available. In view of this, the assessing officer's action of disallowing was appropriate in this case. Now, let's look at the fifth MCQ. I think the last MCQ we are going to look at. So, what is the equity value of RPL if applicable EBITDA multiple is 4? Now, for EBITDA multiple is 4, you need to also have the information. So, let me go to the information sheet, right? So, the last part of the case study talks about and incurred indirect expense of 4 crores for the financial year. So it had made a gross profit of 18 crores and had incurred 4 crores of indirect expenses in the financial year, right? So this is the data also which is required. Now looking at it, coming back here, with respect to the information given, right? What is the equity value if the applicable EBITDA is 4? It also talks about the debentures outstanding is 3 crore. That is, the total debts outstanding is 3 crores, and surplus funds were available to the extent of 5 crores. So these are the information which are available, right? And the EBITDA multiple is 4. Now, any idea what is the equity value? Anyone can do the computation? Just try it out. You can't go wrong. Any thoughts? Somebody is asking what are the options? The options are 53 crores, 58 crores, 64 crores, and 74 crores. Option C, somebody is saying 64 crores. Okay. Any other person having any thoughts? Answer B, 58 crores. Someone says 58 crores. Answer B. Someone says C, 64 crores. So we will sell it to the highest bidder. Good. So, okay, let's look at the computation now so that we understand why and what is the difference. Now, if you go back to the basic data, first thing is EBITDA. So, what is EBITDA? There is a gross profit of 18 crores and there are indirect expenses of 4 crores. So, my EBITDA is 14 crores, right? That's the starting point. So, my EBITDA is 14 crores. My EBITDA multiple is 4, which means the capitalized value, that is the enterprise value, is 56 crores, right? 56 crores. Now, from 56 crores, which is the enterprise value, we need to deduct the debt, which is mentioned as 3 crores. And we also have to add the surplus funds, which is 5 crores. So if you deduct 3 crores and add 5 crores, we arrive at an equity value of 58 crores. Now, what is the logic behind this? The logic behind this is the EBITDA multiple is computing only the business value of the enterprise. So the business value of the enterprise, that's what is called as the enterprise value. Business value of the enterprise is 56 crores. But that 56 crores meant 3 crores is because of some debt which I have, some payable to the outsiders. The whole business is worth 56 crores, but 3 crores belong to the lenders. Only 53 crores belong to the equity holders, right? Then, in addition to the business, the company is sitting on surplus funds, which is not part of that surplus fund is not giving you EBITDA. So, that surplus funds will have to be added separately. This is the principle behind it to arrive at equity value, right? So, that is how you arrive at 58 crores in this case. Now we are going to be looking at the descriptive question. Somebody is put a question, I think. Let me see that. No, there is no sorry. It's all a learning process, right? So there can be sometimes multiple answers also. Of course, not in a question paper, because that would be disastrous to take the exam, right? But otherwise, it can always be there, right? So now we are going to look at some information on the descriptive question. So, based on the information given, analyze and state how the revenue should be recognized in respect of sale of t-shirts by RPL to JML. Now, here what we were seeing from RPL to JML when the sales were being made, this is the background, right? So, initially, it was looking as though they are not going to make that much sales to give a discount, right? Then what happens? By the time they come to December, their mind changes because the facts have changed. Now they are sure, pretty sure, that the target will be achieved on the 10% or 60 rupee per t-shirt. Discount will have to be given, right? So that is the change which is happening in this period. So any thoughts? What is to be done, say in September and then in December? Because we are talking about quarterly accounting. So if you are the auditor, what do you think is the right thing to do in September? What is the right thing to do in December? Any thoughts? Just give it a shot, no? You can always find something interesting there. So can somebody tell me which is the standard we should look at for this? Anybody, any thought on which is the standard we should look at for revenue recognition? Yes, Ind AS 115. Now, what does Ind AS 115 talk about? These kind of discounts being given based on year-end volumes or period-based volumes. This is how we should approach it, essentially. Good. Somebody has said at least part of it, the right answer. 1,200 into 540, right? Should be the accounting. That's partly right. Discount can be deducted. Avoid circumstances for revenue reversal in future. Right. Now, the frank position is like this. So let's look at it in a step-by-step manner. This is how you should also look at it. Like I said, you will be evaluating in September because you will be doing an audit in September if it's a quarterly audit. And then you will be again evaluating for December because December, again, you are doing a quarterly audit, right? So let's look at what the standard says. So Ind AS 115, as somebody rightly pointed out, Ind AS 115 deals with revenue, right? And then that specifically has in para 2056, it talks about variable consideration. What is it that we are now talking about? We are talking about a 600 rupee consideration, but there is also a 60 rupee variable consideration based on certain things, certain milestones, certain progress being made. So there is a variable consideration. Whenever there is a variable consideration, you are expected to estimate, you meaning the company is expected to estimate in accordance with para 53, only to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue will not occur when the uncertainty associated with the variable consideration is subsequently resolved. So it says you should measure it in such a manner that it is highly probable that a significant reversal in the amount of cumulative revenue will not occur. So here the bias is towards. So first thing we should understand is now the new set of standards, they are Ind AS as well as AS, are not talking about conservatism. They are talking about factual position. You cannot be conservative, you cannot be aggressive. That is what is the general. But there are some exceptions. This is one such exception where they are saying that they are only worried about significant reversal of revenue happening later. They are not worried about significant recognition of additional revenue happening later, right? So here, wherever it is highly probable that there will be a significant reversal of revenue, that should not be estimated, right? So in September, if you see, up to September, in 6 months, they have done only 190 t-shirts as against the annual target of 2000. So it is most likely that they will not reach. It's a very fair assumption to reach, right? Very fair decision to be taken at that point of time. So in September, when they account, they would have taken 190 into 600 as the revenue. They would not have provided for the discount as a reduction in revenue in September, right? So let's park that there. The second part of it is December. So when you come to December, what has happened? There has been an acquisition by JML of DCL. So in just 3 months, they have bought 1,200. Our annual target is 2,000. In 3 months, they have bought 1,200 and already 190. So 1,390. The balance is only about 610 to reach the target. 610 is only for one quarter, right? Which is the Jan to March quarter. 610. It's roughly only 50% of what they have bought in the previous quarter. So now suddenly the probability has changed. If you take it at 600, it is highly probable now in December that a significant reversal of revenue will occur in March when you find that they have crossed that 2000. So when the significant changes happened, now what you should do, you should account it at 540. Now here, somebody has also mentioned that 1,200 into 540 should be the revenue recognized. Fair enough. But already I had recognized 190 at 600 rupees. So there also I have to give 60 rupees deduction. So 60 into 190 is how much? 11,400. So should I not reduce that? So when we do the calculation for December, we should not only take the 1,200 at 540, but the 60 rupees extra we had recognized in the previous 6 months should also get reversed. Because you are estimating the variable consideration. Now the variable consideration of 540 will apply not only to the 1,200, but it will also apply to the 190. Right? Yeah. So 648,000 minus 11,400, 636, 600, whatever, somebody has mentioned there, should be the recognition of revenue. Right? So this is the sea change which will happen between the two quarters because of this one requirement under Ind AS 115, which says whenever variable consideration is involved, please estimate. Good. So now we go to the second question, descriptive question. Yeah, this is the calculation. So I'll skip that. The descriptive question 2 is with all the information which has been given. Can the auditor obtain reliable audit evidence in respect of export revenues, particularly for the 4 export invoice of current year? How can she challenge management's assertions regarding the completeness of export revenues for 23-24? So what was she finding? There were 4 invoices. which were not included in revenue, their line of argument was the bills of lading are of April 24. So we have not yet recognized revenue in March 24. So the question is, how can she challenge the management's assertion regarding the completeness of export revenues for 23-24? That is the question, right? Any thoughts on this? How will you audit? What will you look at to see that all revenue have been booked? Any thoughts? Yeah, I think some thoughts have come. Log into GST portal and download all the returns, cross verify. Brilliant. Verify shipping bills, right? Excellent. Because the the question is that the issue was being discussed that they were paying IGST and claiming refunds, right? They were paying GST and claiming refunds. So the best way of looking at it would be to look at the GST returns and the IGST refunds, right? This is a sure short way of looking at it, right? This is how you go and challenge the management's assertions and then question how they are differing. Of course, it's a different dimension that in some cases the revenue is recognized only on bill of lading. In some cases, it is not even recognized on bill of lading. It has to be delivered to the party. So it depends on the Incoterms, which is not part of the current question. So I'm not going into that, right? So getting the electronic data from the GST, and somebody has pointed out from the ICAI, which is the uh, customs database, right? So you can get these information, and with that, you can always challenge the completeness. So this is very good answers. Thank you. With that, we move forward to the last question of this particular case study. In the given information, calculate the expected loss if the hedging is not done. How the position will change if the firm takes forward cover, right? And if the spot rates were INR USD 66.25 and JPY US dollar 110.85, is the decision to take forward cover justified? So these are the questions. For this, you need the information. So the first one is calculate the expected loss if the hedging is not done. How the position will change if the firm takes forward cover, right? Two things. First, let's look at. So this is the current information which is available. The spot rates are 62.22 and 102.34, which is the spot rate. And it is estimated that the Japanese yen will depreciate to 124 and INR to 65, right? And the forward rates available for March are 66.5 and 110.35. Yes, principally we can use cross currency rates to find out, but what is the computation? What is the computation? Anyone has a computation on this? Okay, so let's look at the answers on screen itself. Yes, somebody has put part of it. Perfect. Right. So let's look at the answers on the screen itself so we can look at the calculation. Now, how do you calculate loss? So, calculation of expected loss without hedging. So, if you don't hedge, what happens? Now, my expected rate, not the spot rate, but the expected rate for March is 0.5242, which is 65 rupees by 124 yen. For $1, this is the exchange rates of expected. Expected to be 65 and expected to be 124. So 65 by 124 will be the exchange rate between INR and yen, which is 0.5242. So if I don't cover, I'll get it at 0.5242, right? Now, if I do a forward cover, my forward cover exchange rates today are 66.5 and 110.35. So the ratio comes to 0.6026. Now, if you remember, we had 10 lakh yen outstanding. So 10 lakh yen, if you take at 0.6080, which is on the date we are exporting, spot rate, right? It is 608,000 INR. Then what will be the money received? It will be 524,200. So what is the loss? It is 83,800 will be the loss, right? So if I don't cover, what would have happened? I would have booked my sales at the spot rate. So I would have booked the sales at 608,000 in INR. But finally, when I get the money, I'll only get 524,200. So 83,800 will go as exchange loss. Now, if I take a forward cover, then what happens is my still booking is at 608,000. There's no change in that. But when I get it, I'll get it at 6026, which is the forward cover rate, which is 602,600. So I will have only a loss of 5,400, right? So this is the benefit of forward cover where it is a favorable position or expectation more than anything else, right? Now, the next part of the question is, okay, if the spot rates had changed in March to 66.25 and 110.85, is it justified to continue the cover still? So that is the second part of the question. Same, 66.25 divided by 110.85 gives you 0.5977. So even at that, actually my realization is lower. So it is the loss is more than 5,400. So the decision to take forward cover is still being justified even as of March 24. It's the answer coming from this, right? So like this, there could be questions where you are expected to do some computations and arrive at answers in your exam also. Computations will be fairly simple. It will not be very complex. You don't need a Excel or you don't need a laptop to do it. Calculator, you should be able to do it with the information given. Now we have come to the end of the first case study. Probably we can stop here and take a short break, 10-minute break, and we can start at 8:05. Is that fine with everyone? We can just take a break. Okay, good. So let's have a short break. 8:05 we will reassemble. It's 7:55 now. 8:05 we'll reassemble to take on the second session. Thank Thank you. Yeah. So in the second one, we are going to take up another case study, which again is from the digest published already by the institute. This is the case study from the healthcare sector about this company called Rishi Limited. Right. So we are going to be looking at this case in more detail, and then we can similarly look at the questions on this. So let me give a background about this company. This company had ideated in the minds of two siblings who came from a remote part of India, right? So when they were young, they were seeing that there was rampant and unchecked industrialization, and it was affecting the environment and creating healthcare issues. So like the asbestos, etc. in the past, when industry was unchecked and polluting, there were significant things which were coming up. So these two children, as they grew up, they saw all this, and they saw how the air quality was being made poorer and poorer, which was all leading to healthcare issues for everyone, right? So the two of them went on to do medicine and completed their course. Post completion, they decided to start a hospital, and they formed this company called Rishi Limited. And slowly they built it into a super specialty hospital. It had over 300 beds, and in Assam, it was one of the highest quality hospitals which were there. They had a huge team of expert doctors and other professionals. The hospital had multiple centers of excellence covering various departments like oncology, surgical, then non-interventional cardiology, cardiac surgery, gastro, nephrology, and neurology. So many such departments and centers of excellence were created and were operating well. The hospital also had a critical care capability for both adult patients as well as pediatric patients. It requires special efforts for that. That was also there. Over a period, they grew well and they got listed. And they are now a listed company. Both Riddhi and Siddhi, the two siblings, were on the board of the company. Right? So this was the background of Rishi. From the inception, the company was focused on giving consistent world-class healthcare facilities and healthcare services. So that was the key focus of this hospital and company from inception, which is from the hearts of the founders. They had seen so much of things happening, and it was coming from their heart that they wanted to do this. From that time, the mission statement has never been revised. In every quarterly meeting, there was a lot of people who are raising their desire to improve profitability, become result oriented, innovate, and learn. Occasionally, in informal meetings, employees were told to work ethically and honestly. So this was background focus which was there always, right? Generally, they understood that the whole healthcare works within a community, and they were always looking at it in a holistic manner. So there was also continuous research which was happening in areas like AIDS, cancer, right? And better quality of life, how it can be brought in by better treatments and better prevention mechanisms. Company was also always going in for more complex diagnostic equipments. So this is how they were trying to keep themselves innovative and up in the ladder always. So at one point of time, as the company has grown, etc., the company also sat and thought that it should analyze the internal and external environment of the organization, right? To see how the organization's resources are allocated optimally to achieve its goal. From this, what happened? They had a strategy with the aim to improve the organization's position and how it was responding to external environment where it was required. With all this leading to maximizing its strength and gaining success. That was the focus. Rishi Limited always had a flat fee structure. There were no differential fee, etc. There was a single flat fee structure to make it affordable for everyone. The company had cost effective prices in relation to competition. So they were always trying to manage the flat fee structure with cost efficiency and cost effectiveness with which they were planning to meet the competition. This was the hallmark of the company from the past. However, over the period, what has been happening is more and more younger generation customers were willing to pay for better healthcare experience. They were even willing to pay higher for better healthcare experience. So when you do a flat fee structure, what happens is you are not able to differentiate. Say, for example, if you take rooms which are given for patients to convalesce or get admitted and stay during the treatment period, the rooms will all be of similar type and of basic needs. But today, things have changed and there are a lot of customers who are expecting a AC room, who are expecting a deluxe AC room, and things like that. They have the affordability to do it. At the same time, there is also a huge population which is also looking at much more basic facilities at affordable costs. So there is a differential expectation in the market. However, this company has been focused from inception on its original premises and they have lived by that, the flat fee. So this was all putting pressure on the profitability of the entity, right? And not only profitability and also the money available for innovating, going for the next level of equipments, etc. Though they had managed to a great extent till now. The company in the past had tried joint venture a couple of times and both did not take up well. So their ability to get to work with other organizations to do something jointly for mutual benefit somehow could not work well. And this especially considering the fact that the company itself thought that these two arrangements with other parties could have given a significant boost to the company's profitability. In spite of that, they were not able to manage the relationship and make it work. Right? So this was the background. There was a huge expectation on the professionals to have wide range of technical skills so that they can give the best healthcare services and also with appropriate soft skills to ensure that they give the best possible patient care. This was one of the major focus, right? So these professionals were unique in their skills and they had to be highly trained. The company was showcasing why it was an ideal choice and what differentiates the company in the market by showcasing these talents and these capabilities, right? So the human resources it had was a significant strength which it was putting out to the market also. And to keep this happening, Rishi had been continuously investing in training and further development of people, right? Because with that only you can have the right kind of resources, the right kind of responses, the right kind of patient care, etc., to especially take it to a level that it becomes a differentiator compared to your competitors. So, in fact, companies set aside separate budgets for training and development. So, this was the background to it. The company had many capable and skilled staff, but it had not addressed the rapid growth which is happening within the organization and everywhere. Timely recognition and growth opportunities were the greatest or significant challenges which were being experienced, right? So this is what was being felt from the personnel also, that there is no reward for excellence. The company has always followed a traditional performance appraisal where a manager and employee meet annually. And typically, these are for only about 15 minutes or so, where they review employees' work performance and determine. And based on some predetermined rating systems, they used to decide on the appraisal as well as the move forward for the increments, promotions, everything was revolving around such preset rating systems which were there. These rating systems were set up when the two brothers originally founded the hospital. So many years have elapsed. The company has grown so much. The company has become listed. So many new people have been taken. The market has changed. But this has not changed. It was there as it is. From an organizational perspective also, various departments were working in silos. In fact, so much so that they had to get separate people to integrate data coming from various this thing, had a separate department who could prepare MIS on a consolidated basis, etc., for the management. So it was so much of segregation which was there, and they were all working in silos. One of the consultants they engaged had come up with a grand idea to bring in new technical solutions, technology systems, etc., to significantly change the way the whole company was operating. But the company was not ready to move to such daring changes as it, or what they thought was daring changes as it. Right? So, as I was mentioning, because they were all in silos, there had to be people collating data from that, and there was a management team which was getting this collated data for their own decision making and allocation of funds for various projects, identifying people to be recruited for different departments, etc. So all this was being enabled by a group of additional people who were sitting and working to give consolidated information and data for decision making. So it was not automatically and smoothly integrated. The major lines of business were largely into four segments, And these four segments are nearly completely independent. They were their own profit centers, etc., for each of these business units which were there. All of them operating within the same company. And they were not internally totally integrated, but they were separate silos and separate profit centers with their own focus within that department. In fact, they had a lot of their own core functions, right? Some very few common features were shared between them. Otherwise, it was all pointing towards their own teams. One side, as I was mentioning, the company was very clear that people are very important. So they were supportive of people being taken, people being kept, etc. Of course, in that also, as I mentioned, the appraisal system, etc., were archaic. It had not moved from the times in the past. So it was also found that some of the things they were finding was that the a major issue with staff was that in the lower levels there were a significant amount of female employees, right? But when it comes to mid-level and top level, it was significantly skewed towards male professionals. It also showed that the company was having an attrition of about 30% of the female workforce in every 3 years. Huge attrition was happening. All right. In this background, the company was also coming to the year end, right? And the CEO was called Nidhi. Ms. Nidhi, the CEO, along with the directors, Riddhi and Siddhi, the two brothers, they met with the auditors to discuss on audit plan and their observations, right? So the auditor had also highlighted some of the issues. So the first issue the auditor pointed out was that this RISI Limited had a contract with one company called VC Limited. Let's call it VC Limited, which was a transport agency, right? Which was a transport agency, and that transport agency had provided an ambulance under the contract for a 7-year period. Now, as per the contract, VC Limited can change the ambulance, give a substitute only if there is a breakdown to the van. And otherwise, the same ambulance has to be provided to VC Limited. During this period, the ambulance will be operated by a driver who is hired and put in by RISI Limited. So he will drive the ambulance. And the ambulance will be sent where required by RISI Limited. So it is completely managed by them, but provided by a third party, right? And the third party had a right to change the ambulance only when there is a breakdown or something similar, not in other cases. There were some protective clauses in favor of VC Limited, who has given the vehicle to the company, ambulance to the company. Like, for example, the protective rights included things like you cannot make modifications to the vehicle, right? So this was the first issue which was taken up. Now, what is the issue with that? How to account for this was the issue. So let's park that for a moment, right? And let's look at the other issues also. The second issue which was there is a US company was manufacturing and selling life-saving drugs. So RISI Limited had entered into a contract where it was to buy a certain quantity in October 24 when the price was 100,000 USD. Then it got a delivery on 31st January. October it was procured. 31st January it was delivered when INR to USD was at 160. To enable this procurement, the company had paid an upfront amount of 40,000 USD. Total purchase price was 100,000. 40,000 was paid as an advance upfront, right? When the conversion rate was only 100. But by the time the material came, it had become 160 per dollar. As per the terms of the contract, the deposit will be adjusted against the purchase consideration of 100,000. So 100,000 minus 40,000, balance 60,000. Because the material had come by only end of January, the balance 60,000 is payable by 28th February. And on 28th February, their dollar rate had gone to 150, 150. Right? This was the background. So here again, the question is what conversion rates to use and how to account was issue which the auditor raised. Then the third part was that Miss Nidhi was paid 1 crore of rupees as remuneration as the CEO of the company. Right? In addition, Nidhi was also given certain ESOPs which had a value. I will not go into the value of the ESOPs right now, but basically 2 tranches of ESOP were given to her. One was fully vested during the year itself, one to be vested in the future. So the auditor also raised an issue saying that the managerial remuneration paid to Nidhi exceeded the prescribed limit. So how did he decide that? He decided that based on the fact that the profit before tax, as per the balance sheet given, was showing 10 crores as the profit before tax. Then there was an unrealized gain of 10 lakhs in the books. So he said that 10 lakhs will have to be removed. So the net profit under 198 is 10 crores minus 10 lakhs, which is 9.9 crores or 990 lakhs. So if you take 990 lakhs as the amount available, 11% thereof is 109 lakhs. Okay, so the adjustments are PBT less unrealized gain, amount of as per 198. On that 198, 11%, 109. So his point was that salary paid and recognized is 100. So there is a gap of 9 only. Right? This was the whole point which his auditor had raised. Whether it is right or wrong, we will see later, but this is what he had raised. Then going further, the fourth issue the auditor raised was that Rishi Limited had entered into a contract with Siri LLP to purchase certain materials. Now, Siri LLP was significantly held by Iris LLP, and Iris LLP's majority capital was held by Vani Sole, which is a friend of Riddhi. A friend of Riddhi was controlling the companies which ultimately held a company called Siri LLP, from whom purchases were being made. This Iris LLP also held 5% share capital in the company itself also. Right? So the auditor raised question about whether these would tantamount to related party transactions, and the CEO was of the view that it's not a related party transaction. So this has to be parked aside. Now this is a listed company. We need to keep that in mind, right? So these were the various questions which had been raised by the auditor during the year-end audit discussion in a company which had grown and which was looking to see how it can move into the future, how it can improve its profitability, etc. also, right? So there are pressures for profit, which is there on the company, which also we need to bear in mind, right, when this came. Now, in this context, we are going to be looking at the questions. So, like I did last time, I'm going to share the data so we can look at it in more detail. So, let me do like this. So, I hope you are able to see the information. So, let's look at the first information which we want to see. The first question is about the exchange rate applicability. So the purchase from USA. So what is the question? Assuming that the conversion rate of USD 110 to USD 1, sorry, INR 110 to USD 1 exists on 31st December. At what amount should the foreign currency deposits and foreign currency trade payable be recognized in the financial statements as of 31st December? Right? Now, if you go back to the this thing, right? There are 100,000 is the total amount for which we are buying. 40,000 we have paid as deposit. When we paid the deposit, the conversion rate was 100, right? Now they are talking about 110 as the rate at December. So what are the options? Recognize foreign currency deposit at 44 lakhs. That is 40,000 into 110, 44 lakhs. And foreign currency payable, right? Foreign currency payable is how much? 176 lakhs. Correct? 176 lakhs. Which is $1,60,000 at 110. Basically, the option A is saying the foreign currency deposit and the foreign currency payable should be translated using the exchange rate as at 31st December, which is the date on which we are doing the accounts now. The second option is recognize foreign currency deposit at INR 60 lakhs, right? Which is what we are going to pay in February, 150 into 40,000, 60 lakhs. And the foreign currency payable at 1.76 crores because that is the current rate of 110. So here the idea is foreign currency deposit is done at the exchange rate for the future settlement date, and the exchange rate at year end is applied for the payable, right? So this was option 2. Option 3 is recognize foreign currency deposit at 44 lakhs, like we saw earlier, it's at 110, right? And the foreign currency payable at 256 lakhs. Why 256 lakhs? It is at 160, which was 160 right? 160 came from where? 160 was the rate on the date the material was received, right? So the foreign currency deposit is to be restated at 31st December. However, the foreign currency payable will continue to be at the delivery date. Then the last one is recognize foreign currency deposit at 40 lakhs, which is at 100 rupees. Foreign currency trade should not be recognized. The foreign currency deposit should be recognized using the original rate on the date of deposit, that is 100 rupees when it was originally received. And the foreign currency trade payable should not be recognized at all because this is 31st December, that is going to be January or February, right? So these are the four options. Any thoughts on this December 24 accounts? What is to be done? Anyone coming forward with thoughts? Okay, so let me take it forward.
Option D.
Yeah, somebody has said option B.
D. Fourth.
D.
Yeah.
Okay, D. Okay, someone else has also typed option D. As per Ind AS 21, any deposit is non-monetary item. It has to be converted on that month end only. Right. Okay. Thank you for that. So let's look at the answer. Two parts are there. One part has been answered, right? Option D. Why we are valuing it at 100 rupees, somebody said. Then why foreign currency trade payable should not be recognized? That also we need to understand, right? So what is the transaction flow? Let's look at it. First and foremost, yes, you are right about the foreign currency deposit. The deposit was made on 1st October when the rate was 100 rupees. When you give a deposit for importing material, what are you going to get? You are not going to get cash, or you are going to get materials, right? So the principle behind this, which is what Ind AS 21 says, that if it is not to be settled in cash, right? If it is not to be settled in cash, if it is material to be received, then it's a non-monetary item. So non-monetary items will not get restated. So this being a non-monetary item, it will not get restated. So the 40 lakhs will remain as 40 lakhs in INR, even though the rate has increased by December. Right? That part is clear. Okay, so this is the first part of it. Now, the second part of it is, see, RISI Limited, when will it recognize the trade payable? Only when the material has been received. The material came only on 31st January 25. So in 31st December 24, material has not been received. So I don't have to recognize the payable based on order. I only have a contract. These are executory contracts. So till the contract is actually supplied, the material comes in, I should not recognize the trade payable. That is why D is correct. We should not take the trade payable. Trade payable will get recognized only in January when it actually material comes. Hope that is clear. So let's move to the next question. The next question is about managerial remuneration, right? Very important and interesting thing. Whether the computation of excess managerial remuneration is in accordance with the provisions of the Companies Act. So the options are yes, it is within prescribed limits. No, it is actually 7 lakhs different. No, it is 3 lakhs different. Or the third option is no, it is 19 lakhs different. So let's look at the data for this. She has been paid 1 crore, right? As this thing. And she is also eligible for some ESOPs, which has a value. 7,000 equity settled ESOP at a grant date fair value of 100, exercise price nil, right? And the exercise date fair market value is 150. This is one item. Then there is a 3,000 ESOP, which will vest by the next year end. Both are there. And the auditor had said 10 crores was the PBT and 10 lakhs was the unrealized gain. Okay, these are the facts. The rest of it is computation, right? So what do you think should be the computation? Is there anything wrong in the auditor's computation? Should it be different? Because anyway, none of the answer is 9 lakhs. It is either 3 lakhs, 7 lakhs, or 19 lakhs, or it is within limit. So somebody said ESOP is part of remuneration. Very valid point. What else? Very valid point. Any other thoughts? Okay, so let me take it forward because we will also have to cover all the questions. So I will go forward. So the starting point is 10 crores. Fine, perfect. Right? Then, first and foremost, we should add back the salary paid. The 1 crore salary paid to, what is PBT? PBT is after the salary is accounted for the CEO. We said CEO salary is 1 crore, right? So we should add back that 100, and then we should take the ESOP cost, 7,000 ESOP at 100 rupees because it is fully vested. 3,000 ESOP into 100 divided by 2 because it is vesting only next year, 2 years. So that is about 9 lakhs is the value, right? About 9 lakhs. So we have 109 which needs to be added, and then the unrealized gain, which is correct. Unrealized gain as per 193F is to be adjusted. So unrealized gain we will adjust. So the actual net profit under section 198 should be 1,099 lakhs and not 990 lakhs. The major mistake there was not to add back the CEO's remuneration before determining the profit available. So it's 11% of the amount before their salary, not after their salary, right? So if you take 11% of 1,099, it comes to 121. Whereas the actual remuneration, and here if you see interestingly, what is debited to P&L is only 9 lakhs for ESOP. But when it comes to perquisite valuation, which is what will be the remuneration, it is 7,000 shares into 150. And that is the only thing which will be taken. The 3,000 shares will not be considered now. It will be considered when it is vesting and it is ready for exercise at that time, because it is to be determined under the Income Tax Act, the perquisite. So the perquisite value comes up only on the exercise date and not on the grant date. This is also another important thing we should understand. There is a grant date when some options are given. That time it's only an option. Accounting starts for the cost from the grant date to the vesting date. On vesting date, the employee becomes eligible to acquire that number of shares, but he is not acquired. When he exercises that option is when he acquires the share. At that time only the perquisite value comes on. Perquisite value will come only on exercise. Cost being booked to P&L will be between grant date and vesting date. So that is why there is a difference, and the way it is computed is also different. So 111 anyway is less than 121. So the answer is no, there is no excess payment. So the correct option is A, that the managerial remuneration is within the prescribed limit. The working which the auditor made initially was not appropriate to that extent, right? Okay, so let's look at the next item. Is it clear till now? The third question is whether the CEO was right in our conclusion that purchase of raw materials from Siri would not qualify as a related party transaction. Yes, Siri would not be a related party transaction. Is the first option. B, no, Siri LLP is a related party as per SEBI listing regulation, as it is controlled by a friend of Riddhi, a KMP of Rishi. Thus, any transactions with Siri LLP would qualify as a related party transaction under SEBI listing regulations. This is the second option, right? Third option is, sorry, so there are only two options in this. Yes or no? Obviously, it can only be yes or no, right? So what's your views?
No.
No, is it?
No.
No.
Okay. So B, that means B.
Sir.
Okay. So the correct option is also no, right? Because if you read regulation 21ZC2 of SEBI LODR, related party transactions means transactions involving blah, blah, blah to other person or entity on the other end, the purpose and effect of which is to benefit the related party, right? It's very wide. So when a seemingly unrelated party but has no other relevance to it, is a friend, etc., is doing, it is most likely a related party transaction. So now, in a real world scenario, this has to be further investigated to see various things. Maybe you might find Siri LLP is one of the largest player in that particular item. Then you may not be able to take a flippant view that it is a related party just because he is my friend. However, if you find that that company does not do much of business, this is the major business and they are buying from somebody else and supplying to us, then why should I buy from them, right? Unless it's a subterfuge. So generally, that is the key thing we should look at. Are we buying material from original manufacturers or their dealers or people who are normally trading in that and not from some third party who's just dealing with you on that material, though it might seem to be not a related party. So these are very, very gray areas which needs to be looked at. So that is why here you have to look at it from the SEBI LODR regulation, which is being kept wide open. Where you find such things, it has to be still treated as a related party transaction. Right? Now, the next question is whether the transaction for purchase of raw materials require approval of audit committee or shareholders under the SEBI listing regulations. So, first one is only approval of audit committee is required. Second is prior approval of audit committee is required since the aggregate transactions exceed the qualifying threshold of 1,000 crores. Prior approval of shareholder is also required. Third is prior approval of audit committee is required since the aggregate exceeds the qualifying threshold of 1,000 crores. Approval of shareholder is required, not a prior approval. Okay, not necessarily a prior approval. Fourth one, yes, individually the transactions do not exceed the qualifying threshold. Accordingly, prior approval of audit committee only is required. 4 options are there. Members we don't have to take because individual transactions are less than 1,000 crores. It was for 500 crores and 600 crores or 600 crores and 500 crores. So individual transactions are less than 1,000 crores and hence only audit committee approval is required. It need not have members approval. These are the 4 options. Any thoughts on this? I think we have to move.
Both prior approval of shareholder as well as audit committee is required. So option B.
Okay. So prior approval of audit committee and prior approval of shareholders is required. Right. So that is the thought. Yeah.
Since
Perfect.
the aggregate transaction exceeds 1,000 crore.
Okay. Right. Thank you for that. So let's look at it. Prior approval of audit committee is required, and since the aggregate transactions, the right word you had used, it says aggregate transactions and not individual transactions, exceed the qualifying threshold of 1,000 crores. Prior approval of shareholder is also required, right? Now, SEBI LODR says all related party transactions shall require prior approval of audit committee. Of course, they can do omnibus approval and all that, but approval is required. The second is all material related party transactions shall require prior approval of shareholders, and their material is defined as exceeding 1,000 crores or 10% of the annual consolidated turnover of the listed entity, whichever is lower, right? So in this case, it is exceeding 1,000 crores. So it doesn't matter whether it is below 10% or not, it will be covered. And it uses the word taken together with previous transactions during a financial year. So it is always in the aggregate, right? So that's a critical thing to keep in mind. The next question is on which of the following strategic considerations should Rishi Limited focus on to address emerging needs and improve its market position? Continue with the current flat fee structure without any changes. Update the mission and strategic objectives to incorporate profitability, innovation, and ethical practices. Third, need for a revised approach to partnerships and collaborations. Fourth, implementing the new system suggested by external consultant, which involve generative technologies, machine learning, and AI. Right?
Sir, 4.
Which of the... Sorry?
4 is the answer.
4 is the answer. Okay. So which are the following strategic considerations should Rishi focus on? That is the question, right? Any other thoughts? Anybody?
2 and 3.
2 and 3. Anyone else? Okay, so let's look at the, right? Someone said 2 and 3, right? So Rishi's core strategy spins around providing high quality, affordable healthcare. This strategy has led to a flat fee structure, making healthcare accessible to a broader population in Assam. However, there is an emerging need to cater to new generation willing to pay a premium for better services, right? So that is the first thing. The company should consider updating its mission and strategic objectives to incorporate profitability, innovation, and ethical practices. Unsuccessful efforts in establishing strategic alliance highlight the requirement for a revamped strategy in forming alliance and collaborations. Considering new joint ventures or strategic alliances with a more organized approach may improve both profitability and service offerings. So this needs to be carefully considered. With that, we come to the descriptive questions. The first one is about the van. We were talking about ambulance van, right? The question is, does RISI Limited have the right to direct the use of ambulance while assessing whether there's a lease contract? That is the question. So what did we see about the van? Let's look at that so that we can get some clarity on the van, right? Yeah. So this is the part. There is a 7-year contract. Vahan Chalak is providing an ambulance for 7 years. Vahan Chalak can substitute another ambulance only in case of breakdown. Then during the 7-year period, RISI will put a driver whom they will bring, who will operate the van, and RISI Limited decides how to use the van, such as where it will be sent, which route it will operate. Everything will be decided by RISI, right? The Vahan Chalak has some protective rights, like RISI cannot make modifications to the vehicle, ambulance vehicle, right? So this is what we know about the contract. Does it warrant to say that RISI has the RISI has the right to direct the use of the ambulance so that it becomes a lease? This is the key question. What is your view? Any thoughts? Yeah, somebody has said yes. Okay, so let's look at it. Yes, it is right. So in Ind AS 116, it talks about that customer has the right to direct the use of an identified asset throughout the period. If the customer has the right to direct how and for what purpose the asset is used. So here we saw that RISI can hire the driver. RISI can direct the driver to take it in whichever route it wants, wherever it should be parked, etc. So it has complete control over that. Further, paragraph B30 states that the contract may include terms and conditions designed to protect the supplier's interest in the asset, generally known as protective rights. Protective rights typically define the scope of customer's right of use, but do not in isolation prevent the customer from having the right. What is the purpose of giving the van? To run it as an ambulance. There is no protective right which restricts that. It restricts only those things which may affect the supplier's interest in the asset. Like, for example, you can't make modifications, etc. So some examples of protective rights which B30, para B30 also gives us, specify the maximum amount of use of the asset, right? For example, if it's a vehicle, you might say that it cannot be run for more than 10 hours a day continuously, or a machinery which is stated to run, it has to be given certain hours of rest. So whether to protect that, you may have something. Require a customer to follow a particular operating practice, right? To ensure that the equipment is operated in the right manner so that the equipment longevity is not affected or it does not become repaired. Require a customer to inform the supplier of changes in how the asset is being used. So this is only information. So these are examples of protective rights. So in this particular case, as they have the complete control of how they can use it, it is a lease under 116 because there is a right to direct the use. The second question is about the how aligning actions and decisions with each element of McKinsey's 7S model can help RISI Limited enhance its effectiveness, etc. So this is the second question which is there in the. Any thoughts on this? We can even look at it as each aspect, and you can give me the thoughts relating to that aspect of the 7 factors. Or we can directly look at that. I think we will start looking at it because post that we should have some time for other discussions, if any. So let's see what somebody has put some word. Yes. Skill and system like that we have factor. We will see all that. Yes, there is a skill factor. So let's look at individual factors. The first factor is shared values, right? The 7S model, all starting with S, shared values. So how do you get that? The recommendation is have a clear vision and mission, and values are to be determined according to the existing requirements. In doing so, all stakeholder groups should be identified as well as their particular needs and performance expectations. So you cannot do it only with employees in mind, customers in mind. It has to be holistic. Then only there is a clarity. Senior management must constantly reiterate the importance of values and beliefs to the employees. So that's how you ensure that the shared values are there. Innovation and creativeness are encouraged, right? So that should be reward for change. There should be rewards for calculated risk taking, etc. So if you are not improved that, those are the areas to be addressed. Then the next factor which you should look at is the strategies. So the core strategy is providing high quality, affordable healthcare. So this is what had led to the flat fee structure. We should also identify that there is an emerging need to cater to new generations willing to pay a premium. Now, if you don't do that, they may move to some other hospitals over a period. That's what will happen. So alternate fee structures can create new opportunities and so doing acquire potential new clients. So I can have graded facilities. Improve the competitive position. So in all this, what we should understand is neither flat fee structure nor a varying fee structure is always the right thing. In different scenarios, different things could be right. At different points of time, different things could be right. In fact, the strategy of flat fee structure was probably one of the biggest strengths which brought RISI to this level when it started, right? But today, with changing needs, etc., you need to also change, or you should always be open to change. That is what is basic thing coming from this. So improve the competitive position by creating alliances and partnerships. Again, relook at the alliances, right? Requirement for a revamped strategy to form these alliances or collaboration, because the earlier ones did not work. So we need to find out why it did not work, and we have to come up with different methods of doing it so that it actually succeeds. Because what we saw in this thing, that those two could have been a big boost to their profitability also, which they missed. Should strive towards greater market share by venturing to other states. So that's geographical expansion. Strategies should be responsive to change in market dynamics. This is what I was talking about. You should always be looking to change as the world changes. Then the skills. One of the key things we found is that, yes, the organization had a huge amount of training and development done, so which was one of their strengths, right? However, they had a problem with female professional exits, which were happening heavily. So by introducing gender diversity programs, the company can retain its talented female professionals. So there should be some programs which are brought to address this specifically to ensure that they have a better mechanism there. Then bring in a performance measurement criteria, right, which is in the light of the relevant business environment. We saw that the performance measurement criteria and the appraisal, everything was very old. This needs to be revised to the current scenario. The appraisal must be done more engaging. A 15-minute engagement on an annual basis to decide how good one is or not is not a great way of doing it today, right? So it should move towards a better mechanism there. Reward system, which was pointed out quite a lot of time, right? And job enrichment and enlargement to provide growth opportunities. These are under the skills factor, which can be looked at. Systems, we saw one of the biggest challenges is that they had a silo-based approach. So silo-based approach separates everybody. There is no commonality. There is no common sense, right? There is no integration, etc. So that's one key thing to be looked at. So one of the things which somebody was offering to them to develop and implement a integrated solution, tech solution, they should look at it very seriously. Then from a structures perspective, currently it is on SBU based units, right? Multiple SBUs, each one having their own core activity. So this has to be aligned with the overall entity objective and the SBUs. It needs to be aligned, and the silo should be made into an integrated structure so that common functions are shared between the SBUs. And there should be a clear basis of authorities and responsibilities across all the SBUs and the whole organization. In terms of style also, as we saw, the performance appraisals and all that is conventional. So that needs to change. There has to be more data-driven models towards this. Continuous improvement based on valid measurement of regular process and services should be promoted. So basically more data-driven, more closer evaluations and more closer interactions. And in all this, as I said, data-driven can only come from leveraging technology. Staff is the seventh factor, right? Gender ratio in the middle and top level is skewed. That needs to be addressed. There has to be enablers to reduce exit of female professionals. For example, in many companies, they have brought in creche facilities to ensure that young women, because what happens is we saw that the biggest chunk who are there in female employees are in the young entry level stages, which are young professionals, right? Younger professionals, let's say. And there is a huge attrition, 30% attrition there. Why? Because that is one likely issue is childbirth and the need for taking care, etc. So creche is a very good opportunity to see that you take care of them, so they take care of. There are some IT companies which run huge creche facilities in their own campus to make this happen. Connecting with alumni are not limited to a meeting exercise, but should be leveraged to identify potential employee coming back, right? So somebody has talked about women director and all that. Yes, those are things which are there. Absolutely, right? So this is the 7S model, how you fit in what you read and put it in so that it is used to appropriately analyze. I think with that, we are coming to the end of the case study, but we still have some time. We can discuss the any other questions you have or any clarifications you would like to take. Please feel free to talk. We are here. We can discuss now.
Thank you, sir, for sharing such valuable insights on approaching IBS case studies with the right mindset and strategic thinking. Students, please go ahead and raise your queries. This exam is designed to test your conceptual clarity and application skills, not just about your ability to find definition or formulas. It's about how well you understand the concepts, apply them in real situations and scenarios, analyze complex integrated case scenarios. Why relying only on modules or search and copy won't work in open book exam? It is very important to understand why relying on modules or search or copy won't work in this exam. Let us understand point by point. You may spend too much time trying to find the exact section or theory in the module, especially when the answer is not word to word. If you don't understand the why behind the concept, if you don't understand why behind the concept, even if you find the right term or right framework or right model or right concept or right standard, you may end up with applying wrong concept. You might answer one question by copying text, but there is possibility that concept may kill your time of your next question. What should do? Focus on understanding fundamentals like how performance evaluation works, how McKinsey 7S works, what strategic frameworks, accounting standards, concepts are work. Therefore, you should have at least basic understanding of the concepts. If you don't have basic understanding of concept, in this case, you cannot successfully use open book resources in your exam. Therefore, I am repeating in every session to use open book resources in better manner. You should have at least basic understanding of the concepts. The ICAI modules are excellent reference tools for revision, clarity, and supporting of your answer. Okay, this exam rewards thinking like professional, not just a student. When you approach it with a mindset of analysis, strategy, and applied understanding, you won't just pass, but you will stand out in your exam. Students, please ask if you have any query in my
Hello, sir.
chat
Good
box.
evening.
Yes.
Yes, sir. The paper 6 IBS is structured in the same way as just like descriptive MCQ, it is 70-30, right? It is in the same manner as any other paper which is designed. I mean, the composite paper which we have in CA final. It is in the
In
similar way, right?
Actually, in this paper, weightage is 60-40. If a particular case study is having 25 marks, then 60%, it means 60% is equal to 15 marks. Then there will be 15 marks a descriptive question and remaining 10 marks of MCQs based question. And MCQs based
So
question,
weightage of each question goes to 25 marks.
each case study is having worth of 25 marks. Okay.
Okay,
Then
okay.
descriptive question is having weight of 60%. Then it means 15 marks. Descriptive question can be asked in your examination up to 15 marks.
Fine, understood. Thank you, sir.
Yes. There is one query in my chat box. I have not studied self-paced modules in detail. What should I do now? Okay. I sincerely request all of you to take self-paced seriously. SATA covers corporate and economic laws. One thing is clear. Companies Act will apply to almost all companies discussed in the case studies. Then it is sure you will get question on the Companies Act. Okay. Similarly, if company is listed, then SEBI LODR is again relevant. If there is some foreign currency is involved, then you know FEMA is also applicable in this case. Therefore, I sincerely request to all of you, don't ignore self-paced modules. Overall, you can expect around 15 to 20 marks question from set A. If you have good conceptual understanding, then surely you will get good marks. Regarding set B, as I have already told you, set B covers various strategic models, and all compliances are interconnected with strategic models. Therefore, understanding of various strategic models are very important. Okay. Models like Porter 5 forces, McKenzie 7S, Altman's Z score, etc. In recent examination, there was question on supply chain management, and supply chain management is part of strategic area. Okay. Set B covers not only traditional costing but also strategic portion. Okay. And that supply chain management question was from strategic portion. Therefore, it is very important to go ahead with strategic models also. But how to remember? To remember, create mind map. Okay? It is advisable to practice models continuously and create mind maps. Creating a mind map of key strategic models is very important and useful in your exam. Students, please go ahead and ask queries.
Hello, sir.
Yes.
So in self-paced modules, both theory as well as practicals have same weightage.
There is no specific weightage of theory and practical, but it is advisable to go ahead with strategic models. Suppose if you are asking about set B, then in set B, don't ignore strategic models. Similarly, if I am uh, discussing about set A, then in set A, it is very important to cover all sections which are very, very relevant for corporate governance. Okay?
Okay, sir.
So,
Yes.
the thing is, my group one I have cleared. Group two, I'll be appearing. So
Hmm.
for that, set A is not applicable to me. So
Hmm.
keeping in mind the IBS paper, how shall I approach set A as a what to say? That will also be tested upon. So for IBS paper, how shall I go about with the set A?
And
I'm
what
thinking
about
how to.
group 1 papers?
ग्रुप वन सब क्लियर हो गए मेरे ग्रुप टू का भी बाकी है विच आई बी अपियरिंग इन सितंबर सो सेट बी इज एप्लीकेबल फॉर मी सो सेट ए इज नॉट एप्लीकेबल सो
नहीं, आईबीएस के अंदर आपसे ग्रुप 1 जो फाइनल का जो ग्रुप 1 है वहां से भी आएगा, उसका प्रिपरेशन आपका कैसा है?
अच्छा वहां से ना दैट इज मॉडरेट आई मीन फाइन
हम्म,
that
हम्म,
is actually there has been a gap also in the
हम्म,
period of me clearing the
हम्म,
group one exams
हम्म,
so I would want to know how to approach how to deal with it
हम्म. Even if your primary focus is on group 2, you may select one or two specific paper from group 1. Okay, prepare them thoroughly in addition to group 2 papers DT and IDT. Okay, at the same time, you must have basic conceptual understanding of set A and set B, because this approach not only boosts your performance in examination, but it is base for your long term foundation. The clarity you develop now, especially in subjects like FR, audit, strategic management, or corporate governance area, will continue to benefit you in your professional journey. देखिए, यहाँ पे आप ये कर सकते हैं, आप ग्रुप 1 से कोई एक या दो सब्जेक्ट ऐसा सेलेक्ट कीजिए जो कि आपका स्ट्रॉन्ग एरिया है, ठीक है, उसको आप अच्छा थोरोली कीजिए. आप ये नहीं सोचिए कि आपके ग्रुप 2 के अंदर सिर्फ 2 पेपर हैं. आप अज्यूम कीजिए यू हैव 4 पेपर्स इन ग्रुप 2. ओके, डीटी, आईडीटी एंड 2 अदर्स पेपर, 2 अदर पेपर, ठीक है. और वो जो आप पेपर करेंगे ना प्रिपरेशन, वो आपकी फ्यूचर में भी काम आने वाली है. अगर सपोज आपने एफआर को बेस बनाया, तो एफआर आपको फ्यूचर में भी काम आने वाला है. आप जब सीए बन जाओगे तो वो एफआर के जो एप्लीकेशन है, चाहे आप प्रैक्टिस में रहें, चाहे आप जॉब में रहें, इंडस्ट्री के अंदर रहें, तो एफआर तो हर जगह पे यूज होना है. तो इसलिए आप ये मान के चलिए कि आप कोई ऐसा सब्जेक्ट चूज कीजिए कि जो आपका, जिसके ऊपर कंट्रोल अच्छे से आए, और आगे फ्यूचर में भी आप उसका एप्लीकेशन करना हो. और साथ में जो दूसरे सब्जेक्ट हैं उनको मैं ये नहीं कहूंगा कि इग्नोर करना है. यू शुड हैव एटलीस्ट बेसिक अंडरस्टैंडिंग ऑफ अदर सब्जेक्ट्स आल्सो, ठीक है. अगर सेट बी की बात करेंगे तो एटलीस्ट बेसिक अंडरस्टैंडिंग आपको होनी चाहिए कि मैकेंजी 7S कैसे लगाना है, अभी जैसे सर ने डिस्कस किया. ओके, तो यू शुड हैव
yes
एटलीस्ट बेसिक अंडरस्टैंडिंग ऑफ strategic models like Porter 5 forces, McKinsey 7S, value chain, supply chain management. अभी एग्जाम के अंदर क्वेश्चन आया था सप्लाई चेन मैनेजमेंट के ऊपर. जब तक आपको डाउन स्ट्रीम अप स्ट्रीम सप्लाई चेन के बारे में पता ही नहीं होगा तो आप उसको तो रिप्लाई ही नहीं कर सकते. तो एटलीस्ट यू शुड हैव बेसिक अंडरस्टैंडिंग. अगर आपको बेसिक अंडरस्टैंडिंग है, आप कोई भी क्वेश्चन आएगा आप उसको अप्लाई वहां पे आप एप्लीकेशन कर दोगे. अगर आपको कॉन्सेप्ट ही नहीं पता तो वो आपके लिए डिफिकल्ट हो जाएगा और पेपर में अननेसेसरी टाइम भी वेस्ट होगा. इसी तरीके से इन केस ऑफ सेट ए, corporate governance portion where appointment of directors, resignation, remuneration, okay, these area is very very important because it is connected with corporate governance. You cannot ignore SEBI LODR. Okay, therefore again I am repeating, at in cell page set A B, at least you should have basic understanding. Okay.
So it can so happen that in group one, I make one strength of mine and one, I mean, not so, what to say, which is not so, which is a moderate paper for me. As a combination बना सकते हैं. और the thing, the main idea is to touch upon all these subjects. I mean, the group one has to also.
Yes, but again it depends upon you. It depends upon you. अगर
So the
अगर
combination can be chosen in this way, right? One strength and one weakness, you can say so.
हाँ आप कर सकते हैं, लेकिन डोंट इग्नोर डोंट इग्नोर. फॉर एग्जांपल, अगर आपने अगर सपोज ग्रुप वन से एक पेपर सेलेक्ट कर लिया, ठीक है, तो दूसरा जो
हाँ.
पेपर है उसको भी एटलीस्ट आपको पता होना चाहिए. फॉर एग्जांपल के लिए आपने एफआर सेलेक्ट किया. फॉर एग्जांपल इफ यू हैव सेलेक्टेड एफआर, then you should have at least basic understanding of AFM also, because sometimes you may get easier question from that part. वहां से आपका क्वेश्चन इजी आ जाएगा तो क्या करोगे? अगर आपको फॉर्मूला अप्लाई करना आता है तो आप तो अप्लाई तो कर लोगे, ठीक है ना? तो इसलिए आपको बेसिक अंडरस्टैंडिंग होनी चाहिए. और देखिए एएफएम में क्या होता है कि 4x का क्वेश्चन इजीली कनेक्ट हो जाता है, ठीक है. एक और ये थिंकिंग माइंड में रखिए कि कुछ चैप्टर्स ऐसे होते हैं जो कि इजीली किसी भी केस स्टडी के साथ कनेक्ट हो जाते हैं, ठीक है, लाइक 4x, ठीक है. तो ये चीज भी आपको माइंड के अंदर रखकर चलनी है. उस चैप्टर को, उन चैप्टर्स को इग्नोर नहीं करना. डोंट इग्नोर चैप्टर्स लाइक 4x.
Yes, that is the crux.
Students, any other query? Or can I wind up? Okay. I would like to express our heartfelt thanks to our speaker, CA TV Bala Subramanian sir, for taking the time to be with us and sharing his deep knowledge and experience. Your discussion showed us how tax laws, financial reporting, regulation, strategy are all connected when a company wants to grow responsibly. This kind of integrated thinking is exactly what the IBS paper is all about. To all the students who joined today, thank you for your active participation and thoughtful questions. Your interest made the session even more meaningful. Let today's session remind us about IBS is not just solving case studies, but it is about thinking like a decision maker. Whether you are dealing with FEMA, tax, accounting standard, each case is an opportunity to connect with dots. Each case is opportunity to connect with dots and apply your knowledge in real case scenarios. Keep learning, keep exploring, and most importantly, keep practicing. Practice is key for success. Wishing you all the very best for your preparation. Once again, a big thank you to sir and to everyone who made this session as success. Thank you everyone.
Thank you all.
Yes,
Thank you.
sir. Thank you so much to both of you. Thank you.
Welcome.
Thank you, sir.
Yes.